Should you, dear viewer, go all in on the S&P 500? That is to say, should you invest every single penny of your money that you've put aside for long-term savings into index funds based on S&P Global's S&P 500 stock market index? Well, there's a long answer and a short answer to this question. And to start with the short one, according to economic theory, basically no. The efficient market hypothesis tends to call into question whether anybody can ever outperform by making active bets on stocks. And the S&P 500, if you put all of your money into it, is an active bet on the United States. So for that reason, the S&P 500 is not adequately diversified to represent an entire portfolio and should only make up a component of an individual's portfolio. Having said that, there is a long answer to this question as well, and it just so happens to have the backing of none other than Warren Buffett, a man many consider to be the most successful investor of all time. More specifically, Warren Buffett advocates something like a modified all-in on the S&P 500 strategy, which consists of putting 90% of your money into the S&P 500 and 10% of it into U.S. Treasuries. He's gone on the record as saying that this is the kind of portfolio his wife will be invested into after he passes away. So I've given you basically two very different answers to the should you go all in on the S&P 500 question. One is supported by academia, one is supported by a very, very, very successful practitioner. Which is actually the real answer then? Well, I can start off answering that part of the question by suggesting that maybe Warren Buffett, when he recommended going all in on the S&P 500 or close to it, was talking primarily to an American audience. Warren Buffett is an American investor, he's based in the US, and therefore the majority of his audience is American, and he's probably got the well-being of Americans in mind when he makes public statements. And indeed, Warren Buffett's all in on the S&P 500 strategy has worked out very well over time. In fact, it has worked out much better than the MSCI All World Index. That is an index of thousands of global stocks that much better represents the maximally diversified portfolio that economic theory tends to advocate for. As you can see in the chart below, those who went with the S&P 500 did a lot better historically than those who went all in on the MSCI All World Index. So basically the answer is go all in on the S&P 500, right? I mean, the charts clearly show that it has outperformed the MSCI All World Index, and that's the next best opportunity. So why shouldn't you go all in on the S&P 500? And why were you, Mr. YouTube video creator, just hinting that maybe the answer to how much money you should have in the S&P 500 depends on what country you live in? Those charts don't lie. The S&P 500 has beaten the MSCI All World Index for investors all over the world. Case closed. Well, in fact, it's not actually that simple. You see, the experience that investors around the world get when investing in a specific index depends very much on what country they live in. It all has to do with taxes, dividend taxes. Incidentally, the S&P 500 right now has a relatively low yield, so this different returns to different countries principle is not that applicable to the S&P 500 right now. However, it is applicable to some extent, and the fact is that non-Americans investing in the S&P 500, except sometimes in retirement accounts, don't actually get as good of a return as Americans investing in the S&P 500. The reason is withholding taxes. Countries generally charge withholding taxes to citizens of foreign countries investing in their markets. And in the US, when charged to other Western countries, that withholding tax tends to be about 15%. This is charged on dividends, not capital gains. And while there are some ways to get around it, such as investing in a retirement account, it basically means that the dividend component of the S&P 500's return is 15% lower for global investors than for American investors. And to make matters worse, there's actually only two ways to get around this. One is to hold all of your US stocks in a retirement account, such as, for example, an RRSP in Canada, or to move to the United States. Other than that, there's no way to get around the withholding tax legally. And because all the banks basically handle these things for people automatically, you technically don't have the capabilities to avoid paying it either. And to make matters still worse, you can't even get around this by investing in countries other than the United States, because the vast majority of non-US countries are also charging withholding taxes. For example, Canada charges Americans about 15%, China charges Canadians and Americans about 10%, and the list goes on. So the ultimate answer to whether you should go all in on the S&P 500 or not ultimately depends on whether you are American. If you're American, there is no other stock index that will give you better tax treatment than the S&P 500 does. Furthermore, you live in the United States, so it's very unlikely that your access to the US markets will ever be cut off. So if we start with the assumption that S&P 500 index funds with low costs are good assets, then you as an American will get good tax treatment on a good asset that is likely to perform well long term if you invest in an S&P 500 index fund. Of course, this is not a complete analysis of the S&P 500 index, nor the funds that are based on it. But if you want to hear my opinions on that, be sure to smash that subscribe button, because in the next video, I'll be sharing my thoughts on the S&P 500 in detail. So what then for those of us who aren't Americans? I mean, me personally, I'm Canadian, which means I have to pay the 15% tax on the S&P 500 dividends. What should people in other countries do? Well, a simple principle is that you should overweight your home country's equities relative to the US or any other market, simply because you'll be paying less taxes on the dividends from that country. Now, of course, there are exceptions to this principle. Like if you think that for one reason or another, your country's stock market has a very, very, very high probability of not doing well. But in general, the citizens of a given country are more justified in overweighting that country's stocks compared to other countries' stocks because they pay less taxes on them. You have to be careful with this, though. You don't want to overweight your home country's equities so much that you fall prey to Homefield bias. That is the phenomenon where people, because they're familiar with their country's companies, tend to invest exclusively in their own country, or massively overweighted, say 50%, when it only makes up 5% of the global markets. The better tax treatment that your country's equities will give you compared to foreign countries means that they are worth a little more to you than they are to foreigners, but this isn't a reason to go all in on your country, or even overweight to a ridiculous degree, like 3 or 4x what your country's weighting is in the MSCI All World Index. And in general, for most citizens of Western countries, probably some overweighting of the S&P 500 is still in order. I mean, your country is likely a very close ally of the US, so your access to the US markets will probably not be cut off in your lifetime. For that reason, when considering that, yeah, your country has a little bit of a tax benefit over investing in the US, but not every market has quite got that innovative capitalist spirit that the US has, maybe overweighting your country's equities and US equities relative to the world as a whole is what you ought to do. But what about citizens of non-Western, non-US countries? I mean, countries like China and Russia, for whom the fear of someday losing access to the US market is not totally irrational. This is no academic question. Countries do kick other countries' citizens out of their markets all the time, and when that happens, what it's like if you didn't sell on time is that your holdings in the country that just banned your country from owning shares in it have gone to zero. This actually happened recently to American holders of Russian shares. When Russia invaded Ukraine, what happened was the US immediately put out an order demanding that no US government officials invest in Russia, so they were forced to sell. Then Russia banned the trading of Russian ADRs, that is indirect stock holdings in the United States, and then finally made it super hard. It didn't quite block access to the Russian markets to Americans, but made them very, very hard to access. And as of today, many US holders of Russian stocks are effectively sitting on stocks that have zeroed. That's not to say that these stocks don't trade for a non-zero amount on the Russian markets, but they're not able to easily access those markets. So perhaps if you're Chinese or Russian, what you want to do is invest more heavily in your own country's stocks. Sure, they may not have done as well as the S&P 500 historically, but over time, as your countries grow richer and more capital starts flowing into your markets from your country, regardless of how Americans are investing, maybe they'll start to perform better in the future. History has been full of surprises, and the state of the world is ever changing. while the S&P 500 has outperformed global stocks for a long time, it's not necessarily guaranteed to do so forever. So, should you go all in on the S&P 500? Well, I can't give personalized financial advice. I would say that some general guidelines could be something like these. If you're American, maybe something very close to just the S&P 500 and treasuries is a good strategy for you. If you're a non-American Westerner, then maybe what you want to do is overweight your country's equities and American equities. And finally, if you're in a country that is in the midst of having something of a diplomatic crisis with the United States, like say China or Russia, you might want to overweight your own country's stocks and underweight US stocks. You'll certainly save on taxes, and you might even avoid some tail risk too. That's it for me today. Happy saving.